Is Ford stock the best car manufacturing company one can invest in? What is the current market positioning? What is their growth? And how strong are the business fundamentals? In this video, I'll cover all of this and much more, so stay until the end, and as always set with educational purposes and is not meant to be taken as financial advice. When it comes to any company, it is always useful to start off with examining the potential of its industry. According to Statista, revenue in the passenger cars market is projected to reach 1.9 trillion in 2022. The annual growth is not that impressive, as it is expected to show a 1.72% annual increase from 2022 to 2027, resulting in a projected market volume of 2.07 trillion by 2027. This growth is nothing special, and when the growth rate is so low, we must demand lower multiples for a company, as the only way for us to get decent returns is to buy a cheap enough business when the growth is lagging. Now that we know what is the overall expected growth of the passenger car market, now we must discuss where Ford is sitting in terms of market share dominance. When it comes to global supremacy, Ford ranks on spot number 4 with about a 5% market share as of the end of 2021. The data for 2022 is not out as of yet. Toyota is the dominant leader in the space, and if you want a video about Toyota or Volkswagen, comment down below and make sure to watch my full analysis video on Tesla. In general, the Japanese car manufacturers are all in top spot, with Volkswagen from Europe and Ford for the US making some exceptions. But when it comes to the US market dominance, Ford is a clear-cut number 1. It has a 12.63% share, but in 2021, for the first time, it went quite below 14%. Let us now discuss Ford's latest Q3 business results. Ford Motors recorded a net loss of $827 million during the third quarter, weighed down by supply chain problems and costs related to disbanding its autonomous vehicle unit, Argo AI. Ford updated its guidance to forecast full-year adjusted earnings before interest and taxes of about $11.5 billion. It raised its full-year adjusted free cash flow forecast, however, to between $9.5 and $10 billion. Up from 5.5 to 6.5 billion, on strength in the company's automotive operations. These numbers are incredibly high in relation to the current market cap of Ford, which stands at $45 billion. This gives them about a 4 to 5 earnings multiple, which at first glance looks terrific. This means that if Ford does not grow, but just manages to keep its current results for the upcoming 5 years, then that would mean a double up for the stock. But nothing is certain in the financial world, especially in the automotive industry. A lot of experts think a severe recession is coming, which will for sure dampen demand for all car manufacturers. When it comes to a car company, we must always take a look at their balance sheet, because that is where all the risk is laying down. Ford's total assets are $246 billion, while its total liabilities are $204 billion. This gives them a positive equity of about $42 billion, of which they have $40 billion in cash and cash equivalents. It is ideal for all of the company's equity to be in cash and cash equivalents, as this makes it very liquid. But what is a very weak debt management sign is the long-term debt-to-equity ratio is 3.08. Above 1 is concerning, and this level is 3 times that. The debt to EBITDA is also astonishingly high with 12.93. We want this ideally to be below 3, and this is 4 times that level. So from a debt management perspective, Ford is not okay for me. In such an environment filled with uncertainty, both monetary and financial, it is very risky to invest in companies which are literally buried in debt. The next major pillar would be the business efficiency levels. Their ROIC is sitting at 3.55%. We want this level to be above 12%, as around 10% is the average return we get from the S&P 500 index. We want our company to invest their capital and get meaningfully higher returns. The ROE is a negative -7%, which again is showing us the efficiency of the company is also not ideal. In order for me to invest, I need a company to have low debt, high efficiency, low earnings multiple, and a good MOV. For me, Ford has 2 out of 4 criteria checked, and I am not ready to invest in the company as of now. The risk is just too high for me personally, and I would prefer lower risk companies with higher potential returns. Make sure to watch my other stock analysis videos here on the channel, subscribe for more, and until the next video.